VIP John AG here. The COMEX just failed to deliver on 3 separate silver contracts. 3. Not delayed. Not rescheduled. Failed. This has never happened before in the modern history of this exchange. We are talking about an institution that has operated since 1933, nearly a century of futures trading. And for the first time, we are watching confirmed delivery failures hit the record. Now let me be very specific with you. These were not small retail accounts getting the runaround. These were institutional-level contracts, each representing 5,000 ounces of physical silver, totaling 15,000 ounces that were demanded, confirmed through delivery notices, and simply never showed up. The metal was not there. And instead of addressing it publicly, the COMEX quietly triggered force majeure language buried deep in their rulebook, language that essentially says, "We reserve the right to settle in cash if physical supply is unavailable." Let me say that again. The exchange that is supposed to be the global benchmark for silver pricing just admitted, through its own contractual clauses, that it cannot guarantee delivery of the metal it claims to price. If that does not shake your understanding of how this market works, nothing will. And I am going to walk you through every layer of this because what is happening right now is not a glitch. It is the beginning of a structural fracture that has been building for years, and the data I am about to show you is documented, verifiable, and absolutely damning. Let us start with the numbers because that is where the truth always lives. Silver is trading right now around $32.60 on the COMEX spot market. Gold is sitting near $3,230 per ounce. Bitcoin is hovering around $106,000. Those are your headline numbers. But the real story is not in the spot price. The real story is in what is happening underneath the price, in the plumbing of the system, in the vaults, in the delivery reports, and in the widening gap between what the paper market says silver is worth and what it actually costs to get it in your hands. Let me walk you through the COMEX delivery data because this is where it gets surgical. In the most recent delivery month, total delivery notices issued for silver came in at approximately 11,200 contracts. That represents 56 million ounces of silver that buyers stood for delivery on. Now, here is the problem. Actual confirmed deliveries, meaning metal that physically moved from the registered category in COMEX vaults to the buyer, came in at roughly 41 million ounces. That is a gap of 15 million ounces. 15 million ounces of silver that were demanded through the proper legal channels of this exchange, and were not delivered in full or on time. Some of those deliveries are now showing delays of 8 to 12 weeks. Some are stretching to 16 weeks. And at least 3 contracts, as I mentioned at the top, were not delivered at all, triggering the force majeure provisions. Now let me put that in context. COMEX registered silver inventory, the metal that is actually eligible and available for delivery, has been falling consistently. We are currently sitting at around 36 million ounces in the registered category. Total COMEX silver inventory across registered and eligible is hovering around 278 million ounces, but eligible does not mean available. Eligible means it is stored there. It does not mean the owner has made it available for delivery. So when you look at the actual deliverable supply versus the volume of contracts standing for delivery, you are looking at a system that is mathematically strained. The ratio of paper claims to deliverable metal is now north of 40 to 1 on some estimates. 40 paper ounces for every 1 real ounce sitting in the vault tagged for delivery. This is not speculation. This is documented data pulled directly from the CME Group's own reports. And here is where it gets even more interesting. Over on the Shanghai Futures Exchange, silver is trading at a persistent premium to the COMEX price. The Shanghai premium has been running between 4 and 7% consistently over recent weeks. That means buyers in China are paying over $1.50 more per ounce than the Western paper price suggests the metal is worth. Why? Because in Shanghai, when you buy a contract and stand for delivery, you get the metal. The exchange is physically settled. There is no force majeure clause. There is no cash settlement option. You buy it, you get it. Period. And the fact that the price there is consistently higher tells you everything you need to know about where real supply and demand dynamics are actually playing out. The West is pricing silver on a paper fiction. The East is pricing it on physical reality. And the gap between those two prices is the gap between the narrative and the truth. Now let me connect some dots that mainstream financial media will not connect for you. Over the past several months, central banks globally have continued to accumulate gold at a record pace. China's central bank has been adding to its gold reserves consistently. India has been buying. Poland has been buying. Turkey has been buying. The World Gold Council data shows that central bank gold purchases exceeded 1,136 metric tons last year, and the pace has not slowed. Why is this relevant to silver? Because central banks understand something that most retail investors do not. They understand that the fiat monetary system is under structural stress. They are not buying gold because they think it is a nice investment. They are buying gold because they are hedging against the very system they operate. And silver historically follows gold in these cycles, but with a multiplier effect. When gold moves, silver moves harder. When gold runs, silver sprints. And when gold signals a loss of confidence in fiat systems, silver becomes the most undervalued monetary metal on the planet relative to its fundamentals. Meanwhile, on the geopolitical front, tensions continue to escalate. BRICS nations are actively building alternative payment and settlement systems that bypass the US dollar. Russia and China are settling energy trades in local currencies. Iran is being integrated into the BRICS financial architecture. And every single one of these moves reduces global dollar demand, which long-term is bullish for hard assets including silver and gold. The sanctions regime that the West has deployed, while politically effective in some ways, has accelerated the de-dollarization trend faster than anyone predicted. And the countries doing the de-dollarizing are also the countries that are hoarding physical metal. Connect the dots. Now looking at the numbers, about 75% of you watching right now are not subscribed. If this kind of unfiltered analysis is cutting through the noise and giving you clarity that you are not getting from CNBC or Bloomberg or any of the mainstream outlets, then hit subscribe. That is how we grow a community built on truth and data, not hype and clickbait. Drop VIP, John AG, in the comments so I know you are part of Team VIP. I do not sell signals. I do not sell mentorships. I do not sell courses. I just show up, break down the data, and give you both sides. If that is not for you, no hard feelings. I do not chase empty metrics. But if it is, welcome to the community. Now let us get back into it because we are not even close to done. Here is what makes this truly insane, and this is the smoking gun that I need you to understand because it reframes this entire situation. The force majeure clauses that were triggered on these 3 delivery failures are not new additions to the COMEX rulebook. They have been there for decades. But they were designed for extraordinary circumstances, natural disasters, wars that physically destroy supply chains, events that are genuinely unforeseeable and uncontrollable. They were never intended to be used because an exchange simply does not have enough metal in its vaults to honor its own contracts. That is not force majeure. That is insolvency dressed up in legal language. And here is the part they do not want you to see. When the COMEX triggers force majeure and settles in cash, the buyer does not get the metal. They get dollars. Dollars based on the paper price that the COMEX itself sets. So the exchange gets to fail on delivery, pay you in a depreciating currency at a price it controls, and then carry on as if nothing happened. The seller keeps the metal, or more accurately, never had it to begin with, and the buyer walks away with fiat that does not reflect the true replacement cost of physical silver. This is not a market functioning normally. This is a market managing its own failure through contractual loopholes. And here is the smoking gun within the smoking gun. I went through the CME Group's rulebook, specifically Rule 714 dealing with force majeure, and the language gives the exchange almost unlimited discretion. It allows them to extend delivery periods, modify settlement terms, or impose cash settlement at their determination of fair value. Their determination, not the market's, not the buyer's, theirs. So when you hear people say, the COMEX cannot default because it has mechanisms to prevent it, what they are really saying is the COMEX has mechanisms to redefine what default means. They can move the goalposts in real time. They can change the rules mid-game. And that is exactly what just happened with these 3 contracts. As I said in a previous video, the COMEX is not a free market. It is a managed market. and the management just showed its hand. Now let me also point out something that is getting almost zero coverage. Several major dealers in the physical silver space are reporting delays. Not the kind of delays you see during normal demand spikes where shipping takes an extra week. I am talking about structural delays, 4 to 6 weeks on standard products, 8 to 12 weeks on certain bars and rounds. Some sovereign mint products are back-ordered with no confirmed restock date. The U.S. Mint has been struggling with silver eagle production for years now, and premiums on eagles remain elevated, sitting at $6 to $8 over spot in many cases. That is a 20 to 25% premium above the paper price. If the paper price accurately reflected reality, premiums would be at historical norms of $1 to $2. They are not. They are 3 to 4 times that. And that premium is the market's way of telling you that the paper price is a fiction. The real price of silver, the price you actually pay to hold it in your hand, is not $32. It is closer to $38 to $40 when you account for premiums on retail products. And on the institutional side, large bar premiums are also elevated, running 50 to 75 cents over spot in London, which is unusual for the 1,000-ounce bar market. The Shanghai Gold Exchange physical delivery data tells the same story from a different angle. Physical silver withdrawals from the SGE have been running at elevated levels, with monthly withdrawals consistently above 200 metric tons. That is demand that is being met with actual metal leaving the vaults. Compare that to the COMEX, where registered inventory keeps falling and delivery failures are now on the record. Two exchanges. Two very different realities. One delivers. One delays. And the one that delays is the one that sets the global benchmark price. If that does not tell you the system is broken, I do not know what will. Now let me address the bearish case head-on because balance matters, and I am not here to be a hype man. The bears will point to several legitimate risks, and you need to be aware of them. First, margin hikes. When the COMEX sees too many contracts standing for delivery, one of their primary tools is to raise margin requirements. This forces smaller players to either put up more capital or liquidate their positions. We have seen this playbook before. In 2011, they raised silver margins 5 times in 9 days. They can and will do it again if delivery pressure intensifies. That means short-term price crashes are absolutely on the table, even as the physical market tightens. Second, forced liquidation. If the broader market experiences a deflationary shock or a liquidity crisis, silver gets sold alongside everything else because institutions sell what they can, not what they want to. Silver is liquid. It gets dumped during margin calls across other asset classes. Third, the dollar. If the dollar strengthens significantly due to a global flight to safety, that puts downward pressure on dollar-denominated commodities, including silver. And fourth, industrial demand risk. Silver is heavily used in industrial applications. Solar panels, electronics, EVs, medical devices, defense systems, AI infrastructure. If we enter a global recession, industrial demand could soften, removing one of the pillars of the bull case. These are real risks. I am not going to pretend they do not exist. If you are in this market, you need to have a plan for drawdowns of 20 to 30% because they can and do happen, even in secular bull markets. But here is why the bullish case remains overwhelmingly intact despite those risks. First, the supply deficit. The Silver Institute data shows that the silver market has been in a structural deficit for 3 consecutive years. Annual demand is exceeding mine supply plus recycling by approximately 200 million ounces per year. Let me say that again. 200 million ounces per year of deficit. That means above-ground stockpiles are being drawn down systematically, and those stockpiles are finite. Second, mine supply is not growing. Major silver miners are facing declining ore grades, rising energy costs, stricter environmental regulations, and longer permitting timelines. There are almost no major new silver discoveries being developed. Most silver comes as a byproduct of copper, gold, lead, and zinc mining, which means silver supply is largely inelastic to price. Even if silver doubles, you cannot just open a silver mine tomorrow. It takes 7 to 10 years from discovery to production. Third, industrial demand is not just holding, it is accelerating. Solar panel installations are growing globally at double-digit rates. Each gigawatt of solar capacity requires approximately 20 to 30 metric tons of silver. The AI build-out is driving massive demand for servers, data centers, and electronic components, all of which use silver. EV production continues to grow, and each electric vehicle uses roughly 1 to 2 ounces of silver, double what a conventional vehicle uses. Defense spending globally is increasing, and silver is used extensively in missiles, radar systems, and communications equipment. Fourth, J.P. Morgan. As I have covered in previous videos, J.P. Morgan has accumulated one of the largest physical silver positions in history, estimated at between 600 million and 1 billion ounces, when you include their client holdings and ETF custodial positions. They did not accumulate that metal by accident. They accumulated it over more than a decade. And the entity that was once fined for manipulating the silver market to the downside is now positioned to profit enormously from the upside. They are not dumb. They are not doing this for fun. They see what is coming. Fifth, central bank behavior globally is screaming that confidence in the fiat system is eroding. When the institutions that print money are buying hard assets, that is the most powerful signal you can get. It is not about what they say. It is about what they do. And what they are doing is hoarding metal. 3 key takeaways, and we are out. Number 1. The COMEX has, for the first time in its history, failed to deliver on confirmed silver contracts. This is not a delay. This is not a technicality. This is a structural failure that was papered over using force majeure clauses that were never designed for this purpose. The gap between delivery notices and actual deliveries is now measured in millions of ounces, and the registered inventory available for delivery continues to shrink. The 40-to-1 paper-to-physical ratio is not sustainable, and these delivery failures are the first cracks in the foundation. Number 2. The physical silver market and the paper silver market are telling 2 completely different stories. The paper price says silver is $32. The physical market, through premiums, delivery delays, mint backlogs, and Shanghai price differentials, says the real price is meaningfully higher. When 2 markets diverge this sharply, one of them is lying. And in commodities, the physical market always wins in the end. It is just a question of when. Number 3. The structural supply deficit in silver is now in its 4th consecutive year with no credible path to resolution in the near term. Mine supply is flat to declining. Industrial demand is growing exponentially, driven by solar, AI, EVs, and defense. Investment demand is rising as confidence in fiat currencies erodes globally, and above-ground stockpiles are being systematically depleted. This is not a speculative thesis. This is arithmetic. The unresolved tension is this. We now have documented proof that the COMEX cannot meet all of its delivery obligations. The question is not whether this system breaks. The question is what happens to the price of silver when it does. Does it reset gradually as the market slowly acknowledges the disconnect? Or does it reset violently in a single event that catches everyone off guard? That is the question I will be watching, and that is the question you should be thinking about. This is not financial advice. I am not your financial advisor. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Protect your capital, protect your family, and do not let anyone, including me, make your decisions for you. Invest with logic, not hype. VIP out.